APC, accounting for your future.
Hi, this is Steve from APC and I'm the course director here at APC, and in this video we're going to be focusing on the bank reconciliation statement. So what do I mean by bank reconciliation statement if you think about it in this way? So we've got the cash account, which is the T account within the company, with debit as well as the credit side. And also we've got the bank statements that is given by the bank. So why this is the case is because we open up our bank accounts into our bank, okay, for every businesses. So maybe we're going to use the bank transfer to transfer the money from our bank to others. Or maybe to some extent we received a check, maybe from a customer, but we haven't gone to the bank to clear up this issue. For example, we received a check worth of 100 from our customer A, but we haven't gone to the bank to receive this 100 to update the amount within the bank account, because it's just the check, just the payment that we received, but we haven't gone to the bank. And hence, of course, there would be a difference between the cash account within our company and the bank statement figures from the bank's perspective as well. So for example, the cash account showing as the balancing figure this year is to 100, but bank statement says the cash within the company is only to be $70. So that there will be a difference between these two, and hence what we need to do is we're going to reconcile the cash account onto the left hand side, and we also need to reconcile the bank account on the right hand side. So if we were to reconcile the cash account onto the left hand side, that's called the error correction. It's simply because we've made some of the errors within our cash account, within our company, so we're going to correct those errors. If we were to reconcile the bank statement, so that's called the bank reconciliation statement. So before we dip into that of how to prepare for that, the first thing we need to understand is why there's a difference between 100 and 70. So from my perspective, there will be three particular reasons behind it, and we can call it as the TEN. 10. So the first T stands for the timing difference. So why this is the case is because, for example, the customer goes into our office and gives me a check worth at $100. So what we need to do from a company's point of view, we need to approach the bank, and then we're going to update this $100 because we're going to receive this $100 from the customer. So we need to update our bank account numbers. But since we haven't gone to the bank and tell the bank what's going on, so that the bank statement will show a lower figure compared to our cash account because we haven't gone to the bank to receive this money. So this is called the timing difference. Within timing difference, it can be detailed into two. Firstly, it would be the outstanding lodgement. Is what we've seen before, received a check from a customer, but we haven't gone to the bank to clear up this issue. And another circumstance would be the unpresented check. So what do I mean by unpresented check? Is that when we bought the inventory, for example, we sent out a check to a supplier. The supplier received the check but haven't gone to the bank to receive the money from us, and hence of course we haven't deducted the value from our bank account because the bank is unaware of this because the supplier hasn't gone to our bank, and hence that's caused the unpresented check. Okay. Secondly, because of error exists. So errors may exist mostly into our cash account, or sometimes within our bank statements as well, but mostly within our cash account. So what we need to do is we're going to correct those errors. For example, we should debit the expense and credit the cash paid, but maybe the accountants at that particular time preparing the journals are too tired. They have written debit the cash and credit the income, and hence, of course, this will misstate the cash balances within our cash account on the first side. Of course, it will misstate the financial statements later on as well. And thirdly, it would be because of the unrecorded differences. So what do I mean by unrecorded differences? For example, if we open up a bank account, the bank would charge us an administration fee for each and every year. And that administration fee will be deducted from a bank account automatically in each and every time during the year. But because the bank has deducted it in the first time, maybe we haven't updated the records in our cash account because the bank hasn't told us about that particular issue. So what we need to do is we're going to adjust our cash account in order to show that amount as well. So those are the 3 reasons why the 100 may be different from the 70. So what we need to do right now is that from the accountant's point of view, how we're going to prepare the bank reconciliation statements and also how we're going to reconcile that cash account as well. Of course, for most of our junior financial accountants in the real life, the first thing that they have to do within this company when they first they enter into a company such as me, enter into the company as the financial accountant, I do the bank reconciliation statement. I love tick and cross. It's quite funny. So let's see how we're going to do this using a real life example. So this example is within your study notes by APC. So this example is called Jim. So Jim has his cash account or cash book because we're going to post the totals from the cash book to the ledger account here. Also onto the next page, you've also got the HSBC Bank for the Jim's bank statements as well. As you can see, the HSBC Bank to Jim, account number, the date, and also we've got pay out from your bank account and pay into your bank account so that it will update your balances. So as you can see, we have got the debit as well as the credit sides here for the bank balances here. So bank statement is the statement of financial position from the bank's perspective, for example. So what we need to understand is that if it is showing as the credit balance within the bank statement, this means that the bank is owing us money. If the bank is owing us money, of course it's the credit balance on their account. So that it will be a debit balance into our cash accounts within our company. So that, of course, as you can see, the total balance as at the 24th of October is to be 19,550 credit. This means to us, it is the asset, is the cash asset, is the positive cash balance within our company. Okay, so that's the thing that you need to bear in mind. So what we need to do then is that firstly, we are going to prepare the bank reconciliation statement. So the pro forma that we're going to use is that we're going to use the balance that is not adjusted from the bank statement's perspective. And what we need to do is we're going to adjust for the timing differences. Firstly, we're going to plot the outstanding lodgements. So why this is the case is because we received the money from a customer so that we've updated our cash accounts in the first side. But we haven't gone to the bank to clear up this issue, and hence we need to plot the outstanding lodgements into the bank statement in order to reconcile it. And also we're going to minus the unpresented checks as well. So what do I mean by that is that we send out the check to a supplier because we bought the inventory for maybe to buy the inventory for the first time, but the supplier hasn't gone to our bank to deduct this amount to receive this money from us, and hence within our bank statement we need to minus it as well. So once we've done with those, it can give us the balance that has been adjusted, and that particular balance should be equal to the cash account balance after reconciliation. So the cash account, we got debit as well as the credit. So firstly we got the balance that is not adjusted, and after doing those reconciliation, so that we end up with the carry forward balances, for example here, that amount should be the same as the amount within the bank reconciliation statement here. Okay, so what we need to do for the first thing we're going to do is that we're going to take the figures within the bank statement of 19,550 credit, which is the assets to the company here, and what we need to do then is we're going to consider the outstanding lodgement as well as the unpresented checks. The way that we're going to do it is that firstly we're going to be focusing on the cash book or the cash account on the first side. So what we need to do is we're going to compare those checks in place within the bank statement, and if something happens in the cash account but does not appear into the bank statement on the second page, this means that would be a timing difference. Either it would be an outstanding lodgement or it would be the unpresented check. So firstly, let's have a look at the check 345. So 345, tick for that. So 345 appears here, so that of course we don't have to adjust for it. Okay, so that's how we're going to deal with that, because there's no time difference here because it's been updated in both sides. Secondly, the check 95464 worth at 1,200, so here as well, so no need to adjust for that. And then we've got the check 741 worth at 1,100, so 1,100, 741 here as well, no problem for that whatsoever. And also we have got the check 6532 3,000. So those 3,000, 6532, you cannot chase in the bank statement. So what this actually means is the company has received a check from the customer so that they debit the cash within the company, but they haven't gone to the bank to receive this money, so that the bank statement hasn't updated this. So what you need to do is that this 3,000 is the outstanding lodgement here, so you need to adjust for that. It's related to a check of 6532. Okay, so what about for the credit side within the cash account? So we've got 1,437 worth at 450. So 1,437, 450 here. Tick for that. No need to adjust for that. 1,438 600 here as well. No need to adjust for that because there's no time differences for that. 1,439 750 here as well. And we've got 1,440 of 150. So 1,440, unfortunately, you cannot chase that within the bank statement. So which means what the company actually did is that they issue the check so that they credit the cash within its account. But the supplier hasn't gone to a bank to clear up their money, which means to receive this money from us, and hence our bank statement hasn't deducted this amount. So this is the timing difference, and this is called the unpresented checks. So 1,440 is worth at 450. So we need to deduct it at 150, sorry. So we're going to deduct it from the adjusted bank statement balance. Also we have got the 1,441 250, and we can chase that back from the bank statement. That'll be no problem. Also we got 1,442, which is 350.